The gold market just experienced something that should be physically impossible in a free market. On a single trading day, the price of gold dropped by over 3% in less than 60 seconds. Not because of economic data, not because the Federal Reserve made an announcement, not because war ended or inflation disappeared overnight. It dropped because the exchanges that control gold trading decided it should drop. And if you own gold, silver, or any precious metals right now, you need to understand that what you think you own might not actually exist in physical form anywhere on planet Earth. This is the story of how paper gold has completely disconnected from real gold, how massive trading exchanges in New York and London have created a synthetic pricing system that bears no relationship to actual supply and demand anymore, and how the coming reckoning in this rigged market will either make you incredibly wealthy or wipe out your savings completely, depending on which side of the trade you understand right now. The bloodbath we witnessed last week was not a market correction. It was a warning shot. A glimpse into the structural instability of a system built on leverage, derivatives, and outright fraud that dwarfs anything we saw in 2008 with mortgage bonds. Before we dive into the exact mechanics of how they crashed the gold price, and why this represents the greatest wealth transfer opportunity in a generation, make sure you are subscribed to this channel. Turn on notifications, because when this market breaks for real, you will have hours, not days, to position yourself correctly. Comment below if you currently own physical gold, or if you have been priced out by the recent run-up. I want to understand where this community stands before the next phase hits us all. To understand how the gold market was just manipulated in broad daylight, you have to understand the difference between paper gold and physical gold. When most people buy gold through their brokerage account or their retirement fund, they are not buying actual metal that they can hold in their hand and store in a safe. They are buying a claim on gold, a promise, a contract that says somewhere in a vault there is gold allocated to you. But here is the dirty secret that the entire precious metals industry is built upon. That vault does not have enough gold to cover all the claims against it, not even close to enough metal to satisfy the promises made. The COMEX exchange in New York, which sets the global price for gold through futures contracts, operates on a fractional reserve system that would make any rational person's head spin in disbelief. For every 100 ounces of gold that trades on the COMEX exchange every single day, there are only about 2 ounces of actual deliverable physical metal sitting in the registered vaults backing those contracts. This means the leverage ratio is roughly 50-to-1 in terms of paper claims versus real metal. In a normal commodity market, gold is treated as a competitor to the dollar. It is treated as a thermometer that measures the health of fiat currency and the trustworthiness of central banks globally. When gold rises too fast, it sends a signal to the world that something is breaking in the monetary system entirely. It tells investors that the unlimited money printing and the zero interest rate policies are destroying the value of cash. And the central banks, working in coordination with the largest bullion banks on Wall Street, cannot allow that signal to be sent clearly to the public without intervention. So they have built a pressure release valve into the gold market to control the price when it starts to run away from their targets. That pressure release valve is called the futures market, and it operates 24 hours a day with virtually unlimited leverage for the major players involved in price discovery. Here is how the manipulation works in practice. And this is not conspiracy theory. This is documented in regulatory filings and trading data available to anyone who looks closely at the order flow. When the spot price of gold starts to rise too quickly during Asian or European trading hours, threatening to break through key psychological levels like $2, $100, or $200 per ounce, the bullion banks wait for a specific moment to strike back with overwhelming force. They wait for the transition between trading sessions when liquidity is naturally thin. They wait for a time when most American investors are asleep and cannot react to sudden price movements in real time. And then they unleash a massive wave of sell orders onto the COMEX futures market all at once. Not 100 contracts, not 1,000 contracts, but tens of thousands of futures contracts dumped onto the market in a 60-second window, representing billions of dollars worth of gold that does not exist in physical form anywhere in their possession. The goal is not to sell gold because they want to exit a position at the best possible price like a normal trader would. The goal is to create a price crash that triggers stop-loss orders and margin calls, forcing leveraged buyers to panic and sell their positions at a loss. This is called spoofing when small traders do it, and they go to prison for market manipulation. But when JP Morgan does it, when HSBC does it, when the Bank of Nova Scotia does it, they pay a small fine years later and promise not to do it again, except they do it again the very next week, because the fines are pocket change compared to the profits they make from controlling the gold price on behalf of their central bank masters. The fines are simply a cost of business in a rigged market where the referees are captured by the players. Let me give you the specifics of what happened during the recent bloodbath so you understand this is not theoretical. On the morning of the crash, gold was trading peacefully at $2,185 per ounce in Asian markets. Demand was steady, There was no news event scheduled, no economic data release pending. The market was calm and orderly as physical buyers in China and India were accumulating metal as they do every single day. Then, at exactly 8:32 a.m., New York time during the pre-market session, when most retail traders cannot even access the futures platform easily, a sell order hit the COMEX, representing approximately 18,000 gold futures contracts executed within 90 seconds of each other. Each contract represents 100 ounces of gold. So this was a sale of 1.8 million ounces dumped onto a market with minimal liquidity to absorb the selling pressure. At the current price, this represented roughly $4 billion worth of gold sold in less than 2 minutes by a single entity or a coordinated group acting in concert. The price immediately collapsed by $70 per ounce, triggering every stop-loss order sitting below the market and creating a cascading wave of forced liquidations. Traders, who were long gold with leverage, saw their accounts wiped out instantly as the exchanges issued margin calls automatically. And here is the most telling part of the entire manipulation event. Within 20 minutes of the crash, the price had recovered almost 40 per ounce, as real buyers stepped in to purchase the artificially discounted metal. This proves beyond any doubt that the selling was not organic. It was not a fundamental shift in supply and demand dynamics. It was a coordinated attack designed to shake out weak hands and reset the technical chart pattern to benefit the short sellers who control the paper market completely. This is not the first time this has happened. It is not even the 100th time this pattern has played out in the gold market. If you go back and analyze the intraday price action of gold over the last 2 decades, you will find this exact same pattern repeated over and over again like clockwork. Large dump orders during low liquidity windows, immediate recovery as physical buyers absorb the selling, and then silence from the regulators who are supposed to prevent this kind of blatant market manipulation from occurring in broad daylight. The CFTC, which oversees commodity futures trading, has been investigating gold market manipulation since 2008. They have brought a handful of cases against major banks and collected a few $100 million in fines. But the structure that allows the manipulation has not changed one bit in all these years. To truly understand why this system exists and who benefits from keeping gold prices suppressed artificially, you have to go back to the 1971 Nixon shock, when the United States unilaterally ended the convertibility of dollars into gold. Before that moment, gold was the anchor of the entire global monetary system under the Bretton Woods Agreement signed after World War II. Every major currency was pegged to the dollar, and the dollar was pegged to gold at 35 per ounce, with foreign central banks able to redeem dollars for physical metal on demand from the U.S. Treasury. But by 1971, the United States had printed so many dollars to fund the Vietnam War and the Great Society welfare programs that foreign governments, led by France under Charles de Gaulle, started demanding their gold back in massive quantities. The U.S. gold reserves at Fort Knox were being drained rapidly, and Nixon faced a choice. Either stop printing money and accept a severe recession to defend the gold peg, or break the promise and let the dollar float freely backed by nothing except the military and economic power of the United States. He chose the latter, and the modern fiat currency era was born in that moment of default. Since 1971, the dollar has lost over 98% of its purchasing power measured against gold. An ounce of gold that cost $35 in 1971 now costs over $2,100 today, representing a 60-fold increase that reflects the debasement of the currency through unlimited money printing by the Federal Reserve. But the rise has not been smooth or linear. It has been violently suppressed during key moments when a rising gold price would have exposed the fragility of the fiat system to the general public and caused a loss of confidence in central bank credibility. The most obvious example of this suppression occurred during the 2008 financial crisis. As the world watched Lehman Brothers collapse and the entire banking system teeter on the edge of total implosion, gold should have exploded to $2,000 or $3,000 per ounce immediately as investors fled to safety. Instead, gold actually dropped in the initial panic as the bullion banks dumped futures contracts to keep the price controlled while the Federal Reserve orchestrated the largest bailout in human history. Only after the immediate crisis passed did gold begin its rise to $1,900 in 2011, and even that rally was capped by another massive coordinated intervention. The same playbook was used during the COVID pandemic in March 2020. When the world locked down and the Fed announced unlimited quantitative easing, gold briefly touched $275 per ounce before being smashed back down by the usual futures market selling during thin trading hours. The pattern is so consistent that sophisticated traders now position themselves to profit from the manipulation rather than fight against it. They know the bullion banks will defend certain price levels with overwhelming force, so they fade the rallies and buy the manufactured dips. But the suppression game is becoming harder to maintain with each passing cycle. And this is where the story gets truly dangerous for the financial system and truly profitable for those who understand what is coming next. The physical demand for gold has never been higher in recorded history, particularly from central banks in the East, who are actively diversifying away from dollar reserves. China, Russia, India, Turkey, and dozens of other nations are buying thousands of tons of gold every single year and storing it in their own vaults, rather than trusting Western custodians. According to the World Gold Council, central bank gold purchases in 2022 and 2023 reached levels not seen since the 1960s, when the Bretton Woods system was collapsing under the weight of dollar printing. These are not speculative purchases by traders looking to flip for a profit. These are strategic accumulations by sovereign nations preparing for a new monetary system, where gold plays a central role once again as the ultimate settlement asset between countries. They are buying physical metal and taking delivery, removing it permanently from the Western banking system's vaults. At the same time, the COMEX registered gold inventory, which represents the metal available for immediate delivery to futures contract holders, has been declining steadily for years. It now sits at roughly 20 million ounces, which sounds like a lot until you realize that the open interest in gold futures contracts represents claims on over 500 million ounces. This means that if even 4% of the paper gold holders decided they wanted physical delivery instead of cash settlement, the entire COMEX system would collapse into default overnight. The exchange would have to declare force majeure and settle all contracts in cash at whatever price they decided was fair, likely far below the true physical market price. This is not a hypothetical scenario. It almost happened during the early days of COVID, when the futures price in New York traded at a massive premium to the London spot price, indicating severe stress in the delivery mechanisms. Traders were paying $50 to $70 per ounce more to get physical metal in New York than the paper price indicated it was worth. The basis between paper and physical blew out to levels that should not exist in a functioning market with adequate supply to meet demand. It was a warning that the fractional reserve system was approaching its breaking point. The same stress is building again right now, but the general public is completely unaware because the mainstream financial media does not report on gold basis, spreads, or COMEX inventory levels. They report the paper price as if it represents reality, when in fact it represents a synthetic pricing mechanism maintained by derivatives and leverage that has divorced itself from physical supply and demand entirely. If you walk into a coin shop today and try to buy physical gold, you will pay a premium of 5% to 10% over the spot price, depending on the product. That premium has been rising steadily, indicating that real metal is becoming harder to source even as the paper price remains controlled. The dealers are paying significant premiums above spot to acquire inventory from wholesalers and refineries, which tells you the true supply situation is far tighter than the COMEX price action would suggest to the casual observer. This divergence between paper and physical is the crack in the dam that will eventually break the entire price suppression scheme wide open for everyone to see. But gold is not even the worst example of manipulation in the precious metals complex. If you want to see truly egregious price control that defies all logic and economic law, you need to look at the silver market. Silver is a smaller market than gold by total value, which makes it easier to manipulate with large orders. And silver has the added complexity of being both a monetary metal and an industrial commodity with applications in solar panels, electronics, and electric vehicles that are consuming supply at record rates every year without replacement. The global silver market produces roughly 1 billion ounces per year from mining and recycling combined. But industrial demand alone now consumes over 600 million ounces annually, and that number is growing as the green energy transition accelerates and requires massive amounts of silver for conductivity in panels and batteries. Jewelry and silverware consume another 200 million ounces. That leaves only 200 million ounces for investment demand from buyers who want to own physical metal as a store of value or inflation hedge. Yet despite the supply deficit, despite the fact that above-ground inventories are being drawn down year after year, the price of silver remains stuck in a range that makes no mathematical sense. Silver trades at roughly $24 per ounce today, which is barely above the all-time high reached in 1980 when the Hunt brothers tried to corner the market. Adjusted for inflation, that 1980 price of $50 would be over $180 in today's dollars. So silver is trading 85% below its inflation-adjusted peak, even though industrial demand has exploded and mining supply has plateaued due to declining ore grades worldwide. The suppression of silver is even more blatant than gold because the concentration of short positions is insane. A handful of banks, led by JP Morgan before they exited the position in recent years, have held short positions, representing over 100 days of global silver production. Imagine if a single trader held short positions equal to 3 months of global oil production. Regulators would shut that down immediately as a threat to market stability and price discovery. But in silver, the CFTC has allowed this concentration to persist for decades, despite thousands of complaints from investors alleging manipulation. JP Morgan paid nearly $1 billion in fines in 2020 for spoofing the gold and silver markets over an 8-year period. Traders at the bank were convicted of criminal fraud and sentenced to prison for placing fake orders to manipulate prices in their favor. But the fine was a rounding error compared to the profits the bank made from the scheme. And more importantly, the structural ability to manipulate the market remains intact today under different players using the same tactics. The reason silver matters so much in this story is because silver is the pressure point that could break the entire precious metals manipulation scheme. The market is small enough that a concentrated buying campaign by retail investors or a single sovereign wealth fund could overwhelm the available physical supply and force a short squeeze that would send prices vertical. We saw a preview of this in early 2021 when the Wall Street Bets community on Reddit attempted to squeeze silver the same way they squeezed GameStop stock. The movement failed because most retail buyers did not understand the difference between buying physical metal and buying the SLV ETF, which is paper silver that can be created infinitely by the authorized participants. But the idea was sound, and it terrified the bullion banks enough that they launched a massive propaganda campaign to convince retail investors that silver was a distraction from the real fight in meme stocks. The truth is that a silver squeeze would have been far more damaging to the financial system than a stock squeeze, because it would have exposed the fractional reserve nature of the entire precious metals market and potentially triggered delivery failures that cascaded into gold and other commodity markets as well. This brings us to the ETF scam that most gold and silver investors do not fully understand when they buy shares through their brokerage account. The largest gold ETF in the world is GLD, which holds roughly 900 tons of gold in various vaults around the world on behalf of shareholders who own the fund. When you buy a share of GLD, you're buying a fractional claim on that gold. But you do not own the gold itself, and you cannot redeem your shares for physical metal unless you are an authorized participant with the resources to transact in 100,000 share blocks worth millions of dollars. For the average retail investor, GLD is purely a paper proxy for gold price exposure. You are trusting that the custodian, which is HSBC, actually has the gold they claim to hold, and that it has not been leased out or hypothecated to multiple claimants simultaneously. The fund's prospectus contains language that absolves the custodian of liability in the event of loss or theft, and it explicitly states that the gold may be held in allocated or unallocated form depending on operational needs at any given time. Allocated gold means specific bars with serial numbers are assigned to the fund and segregated from other holdings. Unallocated gold means the fund has a general claim on a pool of gold held by the custodian, but the specific bars are not identified and the gold can be used for other purposes, including lending to short sellers who need to borrow metal to deliver against their positions. This is rehypothecation, the practice of using the same asset as collateral for multiple obligations simultaneously, and it is perfectly legal in the precious metals market under current regulations. So when you buy GLD shares, thinking you are getting safe exposure to physical gold, you may actually be funding the very short selling operations that suppress the price of the metal you are trying to invest in for protection. Your capital is being used against you in a shell game where the same bars of gold are claimed by multiple parties. And the music keeps playing as long as nobody asks for delivery at the same time. It is fractional reserve banking applied to precious metals, and it works perfectly until there is a run on the system. The same structure exists in silver through the SLV ETF, and in platinum and palladium through their respective funds. These are not true physical ownership vehicles for anyone except the largest institutional players who can take delivery. For everyone else, they are derivatives that allow the bullion banks to expand the paper supply of metals infinitely to meet investment demand without actually having to source physical metal from mines or refiners. This is why the ETFs can grow to enormous sizes, while premiums on physical coins and bars remain elevated. The paper supply is elastic, but the physical supply is constrained by geology and refining capacity. Now, if you're starting to feel like the entire precious metals market is rigged against the small investor and designed to benefit the banks that control the infrastructure, you are absolutely correct in that assessment. But understanding the rigging is the first step to positioning yourself on the right side of the coming reset. Because while they can manipulate the price in the short term using futures and derivatives, they cannot create physical gold and silver out of thin air, no matter how many contracts they print on the COMEX exchange. The laws of supply and demand cannot be suspended forever, and the physical market will eventually overwhelm the paper market when the divergence becomes too extreme for the system to maintain credibility. We are approaching that inflection point right now, and the investors who positioned correctly before the break will see returns that dwarf anything available in traditional financial markets. So how do you protect yourself and profit from the inevitable collapse of the paper gold pricing system? The first and most important rule is to own physical metal that you control directly, not through a third-party custodian or ETF structure that can be altered or frozen during a crisis. This means buying coins and bars from reputable dealers and storing them either in your own possession or in a private vault that is fully allocated and segregated from other assets. Do not store your precious metals in a bank safe deposit box, because those boxes can be seized or restricted during a banking emergency under existing regulations. When buying physical gold, stick to recognized coins like American Eagles, Canadian Maple Leafs, or South African Krugerrands that are easily verified and liquid in any market worldwide. Avoid rare numismatic coins or exotic private mint products that carry huge premiums and are harder to sell when you need liquidity quickly. You are buying gold for wealth preservation and insurance, not as a collectible hobby. The premium you pay over spot should be minimal, typically 3% to 7% depending on the product and dealer you use. For silver, the same principles apply, but the premiums tend to be higher due to the smaller size of each unit and the costs of fabrication and shipping. You can reduce your premium by buying larger bars like 100-ounce or 1-kilo bars instead of 1-ounce coins, but this reduces your flexibility when you want to sell small amounts. A balanced approach is to hold a mix of sizes so you have both bulk weight at low premiums and smaller denominations for transactions if the currency system experiences severe disruption. The second strategy is to understand the difference between trading paper gold for speculation versus accumulating physical gold for long-term wealth protection. If you want to trade the gold price for short-term gains, using futures or options on the COMEX can provide leverage and liquidity that physical metal cannot match. But you must accept that you are playing in a rigged casino where the house has unlimited chips and can change the rules mid-game to ensure they win. Trade with money you can afford to lose and never use leverage that can wipe you out on a single manipulated price spike or crash. For long-term wealth protection, physical metal is the only option that removes counterparty risk completely from the equation. When you hold a gold coin in your hand, you own an asset that has been money for 5,000 years and will remain valuable regardless of what happens to any government, currency, or financial institution. It cannot be printed, diluted, or hacked. It has no counterparty risk and no default risk. It simply exists as stored energy and labor from the past that can be exchanged for goods and services in the future. The third critical insight is to watch the basis between paper and physical gold as a warning sign that the system is approaching failure. The basis is the difference between the futures price and the spot price, adjusted for carrying costs like storage and insurance. In a normal market, the basis is small and stable, reflecting the cost of holding physical metal over time. But when stress enters the system and physical metal becomes scarce relative to paper claims, the basis blows out as buyers pay premiums to secure delivery. We are already seeing early signs of this stress in the gold market right now as premiums for physical delivery have risen in recent months. Coin dealers are reporting delays in supply from the major mints, and spreads between bid and ask prices have widened as inventory becomes harder to source at current price levels. These are not front-page headlines in the Wall Street Journal, but they are flashing red warning lights for anyone paying attention to the actual mechanics of the physical market. When the break finally comes, it will happen faster than most investors can react. The price of physical gold will gap up violently as buyers rush to secure metal and sellers refuse to part with it at the old suppressed prices. The COMEX may declare force majeure and settle contracts in cash at the last traded price, leaving futures holders with dollars instead of metal while the physical price soars to $3,000 or $5,000 per ounce overnight. This is not speculation. This is exactly what happened in the nickel market in 2022 when the London Metal Exchange suspended trading and canceled trades after a Chinese company faced a massive short squeeze that would have bankrupted them. If the LME can cancel trades in nickel, the COMEX can absolutely do the same in gold when the short positions held by the bullion banks become untenable. They will protect the banks at the expense of the traders who were on the right side of the trade, because that is how the system is designed to function. It protects the insiders and punishes the outsiders who challenged the established order. The fourth strategy is to position yourself in the mining stocks that will benefit from rising precious metals prices and the re-rating of the entire sector. Gold and silver miners have been brutally undervalued for the last decade, as the suppression of metal prices made it difficult for them to generate strong cash flows and returns on capital. But when the paper price breaks and resets to the physical price, the miners will experience a profitability explosion that sends their stock prices vertical in a matter of weeks. The key is to focus on high-quality producers with low costs, strong balance sheets, and management teams that have a track record of disciplined capital allocation. Avoid the junior exploration companies that promise huge discoveries but burn through cash and dilute shareholders endlessly while never actually producing an ounce of metal. Stick with the senior and mid-tier producers that have operating mines, positive cash flow, and the ability to expand production as prices rise. But even with mining stocks, you must understand that these are paper assets, subject to the same risks as any other equity investment. They can be halted, delisted, or nationalized by governments during extreme crises. They provide leverage to metal prices, but they do not provide the same safety and permanence as physical metal held outside the financial system. Use them as a speculation, not as your core precious metals holding. The endgame for this entire manipulation scheme is a reset of the global monetary system where gold returns to the center of international finance as the settlement asset between central banks. The BRICS nations are openly discussing a gold-backed trade currency to bypass the dollar for commodity transactions. China and Russia have been accumulating thousands of tons of gold for over a decade in preparation for this shift. The signs are everywhere if you are willing to look past the mainstream narrative that gold is a barbarous relic with no role in modern finance. When the reset happens, the price of gold will not be set by the COMEX in New York or the LBMA in London. It will be set by the physical market in Shanghai, Dubai, and other Eastern trading hubs where actual metal changes hands rather than paper contracts. The West will lose its pricing power over gold, the same way it is losing its dominance over global energy markets and manufacturing capacity. This transfer of power is the megatrend of the next decade, and precious metals are ground zero for the wealth transfer that accompanies it. Your choice is simple. You can own physical gold and silver that you control directly, positioning yourself for the reset and the repricing that is coming. Or you can trust the paper system, the ETFs and the futures markets that have been rigged against you for decades by the very institutions that claim to be providing you with fair price discovery and market access. One path leads to wealth preservation and potential generational gains. The other path leads to wealth confiscation through inflation, default, and the collapse of the fiat currency system that underpins everything you think you own. The bloodbath we witnessed in gold last week was not the end of a rally. It was the last desperate attempt by the bullion banks to shake out weak hands before they lose control of the pricing mechanism entirely. The physical demand is too strong, the supply is too constrained, and the geopolitical shifts are too far advanced for them to maintain the suppression much longer. The dam is cracking, and when it breaks, the flood will be biblical in its speed and magnitude. Thank you for watching this deep dive into the gold manipulation complex and the coming precious metals reset. If you found value in this breakdown and want to stay ahead of the collapse, subscribe to this channel immediately. Turn on notifications so you know the moment the system breaks and physical premiums explode beyond the reach of average investors. Share this video with anyone who owns precious metals or thinks they are protected by ETFs and paper gold. They need to understand what they actually own before it is too late to make changes. We are tracking every delivery failure, every inventory drawdown, and every basis blowout in real time, so you do not have to wade through the data yourself. This is not financial advice, but it is information that your financial advisor will never give you because they are paid to keep you invested in the system that is failing. Protect your wealth, buy physical metal, and prepare for the greatest wealth transfer in modern history. I will see you in the next video with more data and analysis. Until then, stay vigilant, stay liquid, and get physical.